Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
Welcome to Optimal Insights, your weekly source for timely market analysis and expert commentary from Optimal Blue. I'm Jeff McCarty, Vice President of Product Management at Optimal Blue. As you may notice, Jim's not here today, but joining me are Kevin Foley, Director of Product Management, Alex Hebner, our resident economic guru, and recurring guest, Vimi Vasudeva, our resident MSR expert. Let's dive into today's episode. All right, so welcome, Alex, Kevin, Vimi. We've got a great show today. We'll focus on some of the economic data that came out last week, obviously talk about the Fed announcement coming up this week, and then Vimi and I will get into an update on the state of servicing right now after one of our big servicing conferences in the industry that we had last week. So excited to dig into that a little bit later on. So first, quick look at the data. Really kind of the state of the market is everything's flat right now. So OBMMI hovering around 6.75, 6.755, I think as of the end of the day Friday on the conforming 30-year. 10-year is pretty flat at around 4.3. Stocks started the day down, but they've come up a little bit and they've been pretty flat. They've made a little bit of a modest rally off the lows over the past couple of weeks. So, everything is looking pretty flat at the moment. We're kind of just waiting for the other shoe to drop, waiting to see where things shake out with tariffs, where things shake out with some of these budget proposals. So we'll dig into some of that as we go. So let's dig into it. All right. Welcome, Kevin and Alex.
Yeah, good to be here.
Thank you.
So let's jump right into it. Let's talk about the kind of two big economic releases from last week.
Yeah, definitely. I think I'll start with employment. First week of the month, first Friday of the month, we got some non-farm numbers there, and they were really solid. Honestly, they beat expectations. Saw a couple tens of thousands additional jobs than expected, which really put the worries that kind of emerged midweek about the ADP survey. The ADP survey came in well under expectations, like I believe somewhere around half. We saw continued growth in the healthcare sector, 50,000 jobs there. Kind of a surprising one that I caught was around 30,000 jobs in the warehousing and transportation services. That to me seems like maybe kind of in line with the front running of imports that we've seen, maybe some part-time work being generated there. Definitely kind of want to keep an eye out on if we see any contractions in that in the coming months and quarters. But we also had some GDP numbers last week, which were pretty disappointing, kind of in line with those Atlanta Fed projections have been showing that the economy is slowing, if not contracting. But I was chatting with Kevin this morning, and we were just chatting about, how much credence to give this particular release and what that negative 0.3% GDP release actually means.
Yeah. So, and I think this is interesting. So a lot of folks have already talked about how, because of the way that the GDP calculation works, if you have, a significantly higher number of imports, in a given quarter, that's going to drag down GDP. And we can talk a little bit about that. And theoretically, it should all sort of even itself out. But the main reason, to your point, Alex, that we saw a contraction was because of that really high number of front-running imports, folks trying to import everything they can abroad before the tariffs kicked in. But I think if we take a step back, Q1 GDP, I think, is kind of the least reliable quarter in terms of indicating for us where things are actually going. And the Federal Reserve has actually done some analysis on this. They published something back in 2017. And what they published over a period, it was in the 2010s, looking backward, on average, Q1 GDP growth was about 1.3% below the growth for the year. And I've also taken a look, like if you look at the last 10 years of data, and let's take out 2020 just because that was an anomaly. So 2014 through 2024, Q1 GDP was the lowest quarter for growth of the year 5 out of 10 times. And the likelihood of that happening with random data is about 6%. And the Fed actually has a term for this they call residual seasonality. They take into account things like the weather in their calculations. But what's interesting is that the Bureau of Economic Analysis, the BEA, they don't actually take what the temperatures were, what the weather was in Q1 as an input to the seasonality. They just base it off of the historical data. And on top of that, if you look at the possible temperature spread in the contiguous US, where it's at its highest is in Q1. So the most variability between the possible high temperatures and possible low temperatures. So I've got this theory that given the temperature variation in winter, that the BEA is unlikely to get the seasonality adjustment nailed down unless they start taking temperature or weather data as an input into the adjustment. Now, whatever effect that had, I think probably some, because it was colder than average winters, sort of relatively speaking versus the last few years. Whatever effect that had, probably swamped by the whole tariff conversation. But even that's sort of interesting, right, Jeff? Because technically things should really even out. If you have more imports, you'd expect kind of an offsetting adjustment there for investment, right?
First of all, I got to go back to you're taking the phrase "taking the temperature of the economy" quite literal right there, Kevin. So
resident meteorologist.
Right. That's great. No, but as you said, there's been so much focus on the GDP equation over the past couple months and how net exports plays into the role of GDP. But as you said, that net export number should be offset by either investment or consumption. If there was a flood of imports to try to get in front of tariffs towards the end of Q1, that should be counterbalanced by an increase in either investment or consumption, which should come into the GDP number as well. And so I was reading a few interesting things that maybe those import-export numbers much easier to measure just because you're counting what's coming in and out of ports, versus investment and consumption numbers are based much more on survey results. And so maybe those survey results aren't quite as accurate, or maybe there is a little bit of lag in those survey results. So again, it goes back to maybe our conversation from last week, where we got to have a little bit of patience. We've got to not rely too much on one number, because there's going to be a lot of noise, especially with how quickly things are moving right now with these tariff announcements. How much noise is there in one part of the equation versus the other? Or it could be, we're truly seeing a decrease in GDP. So
it does feel like this year in particular, the Q1 GDP numbers, you really just almost got to throw them out the window, because the factors that were at play in Q1, the front running of imports before tariffs, not there anymore. There's a seasonality adjustment. There's, all sorts of questions around surveying data, how that's going to play into things. And the factors going to Q2 are very different. So to your point, I think we just got to be patient and see how things play out over the coming quarters.
One other thing worth mentioning over the past week, maybe just the 2026 budget proposal from the White House and how it affects our industry specifically. So, obviously a pretty aggressive budget cuts proposed in that, over 180 billion in budget cuts. A good portion of that was focused around HUD. I think 27 billion in cuts to HUD. Although a lot of that comes from a lot of down payment assistance programs, some affordable housing programs. So nothing kind of broad across general FHA, Ginnie Mae, staffing, or anything like that. Nothing like that right now. So I think, as far as overall stability of our industry in particular, nothing to be too concerned about yet, although these budget proposals are pretty broad to start. So it's hard to see, what type of details, but certainly something to watch as we get more details about those budget cuts.
Yeah, that was going to be my comment, that I just think, this is a proposal, take it with a grain of salt, and it's coming from the White House. The White House doesn't control the purse strings. They do have Congress, on their side. They have majorities in both houses. We'll see those plans dialed back, I would imagine. And they have a lot of lead time here too. I don't think they need a budget until September, the early fall. So
yeah, to your point, Alex, the way that I see these things, in a White House, whoever's in the White House proposes a budget, is it's more to try and, get the folks who are maybe most likely to peel off on board for whatever it is that they're trying to do, whether that's budget cuts or, increasing spending. So it's really just all kind of part of the, negotiating that's happening within Congress. So interesting to see what the numbers are and just get a sense of, what it is that they're trying to push, but certainly a long way to go before anything like that comes to fruition.
All right, so then let's start talking about the big announcement coming up this week, the Fed announcement on Wednesday.
Yeah, yep. We are around to another FOMC meeting. We'll get that on Wednesday. Drama surrounding Powell, Trump, butting heads there has definitely subsided, I'd say, over the past 2 weeks since it really was kind of capturing headlines. I think the news, and we were talking about this just before the show, but CME FedWatch tool this morning dropped off the chances of a rate cut at the June meeting. So not this meeting, but the next meeting, really kind of dropped off a cliff from being around 60% sometime last week to under 30% this morning. So definitely seeing like a reevaluation of if there's going to be rate cuts incoming in the the near future inside this quarter. There is an additional FOMC meeting in July. I'm still seeing a majority of expectations there being for a rate cut in July, but it does seem to be a bit of a kick the can moment. I agree personally. I think the data isn't quite there to support a rate cut at the moment. We just got, like I said, a great jobs number. Rate cuts are designed to, amongst other things, promote employment. So with a 4.2% unemployment rate, it doesn't make a whole lot of sense to make a cut at this juncture. Thursday, we get some initial jobless claims, another survey. Just keep an eye out for weakness there. And then Friday isn't anything data specific, but we have a whole slew of Fed governors and board members all with speaking engagements. They have a blackout period up in the 2 weeks preceding an FOMC meeting. So on Friday, they're free to attend speaking engagements. And we have, and I'll read them off here. We got Barr, Williams, Kugler, Barkin, Waller, Cook, and Bowman, all with different speaking engagements on Friday. Some of them are on panels together, and some of them are at solo speaking engagements. So keep an eye out there. I think they could provide some additional clarification that we might not get on Wednesday out of Powell's press conference.
Somebody's gonna, with that many speaking engagements, somebody's gonna slip up and say something provocative, right? Are we gonna get anything interesting this week? I think the Fed announcement, they're gonna be overly conservative in their language to make sure they don't, as usual, say anything particularly interesting.
I would agree. And these folks are well trained. They're PR. They're extremely well PR trained. They know what to say and not to say. I personally would love to hear them, say something a little more out of pocket, or, give us a more fly on the wall in their meeting type of point of view. But we'll see. We'll see. I do think, just watch for changes in language regarding, the rate cut expectations this summer, because part of their job is setting policy, but a large part of their job is also managing the expectations about that policy. So just keep an eye out on how they address any questions regarding rate cuts into the middle half of this year.
Yeah, I'm sure there's going to be a lot of traders looking to read the tea leaves next week, is in terms of what they say. So, and we'll see. They always do those statements where they highlight keywords. And, so I'm going to be interested to look at some of those outputs to see how many times they talk about uncertainty or, growth or challenges or things like that. So,
yeah, going back to expectations going forward. I mean, we talked about how even the June cuts are looking less and less likely. And then looking through the end of the year, people were expecting about 4 cuts. That was kind of the plurality of what expectations were 4 cuts this year, and now it's shifting more towards 3 cuts. Even as Trump tries to pressure, explicitly ask for rate cuts, we're kind of shifting in the other direction just based on the data that's out there, right?
Yeah, I think they're making a point of remaining data dependent. I think that'll be something that they highlight in their speaking engagements. But yeah, I think, and I tend to agree there. I don't think I think a full point cut this year seemed a little unwarranted, unless they were really trying to get out ahead of something that they're seeing that the rest of us aren't quite. A lot of storm clouds on the horizon, as we talk about every week on this podcast. But again, unemployment's at 4.2%. There's no, black swan events, no bank failures, no COVID or anything like that. But again, black swan events, they're called that for a reason. They come out of almost nowhere. So,
yeah, I think to pick up that point, one thing that I'm seeing and reading more and more, the Wall Street Journal just did an article about it, but the folks who are very plugged into tracking shipping are starting to notice a drop off in container ships coming from Asia to the US. And typically, if something like that were to happen, and there's past instances during COVID and whatnot where we saw similar mechanics, that that could potentially lead to troubles in the next couple months in the retail sector. So something to keep an eye on. I've been seeing it talked about more and more. Whether that comes to fruition, I'll have to keep an eye on it.
Absolutely. I've read a number of articles. One, about a third contraction. And as you said, Kevin, shipments coming towards the West Coast right now. And then in addition to that, just also backups at the ports, those that can wait with their goods on a ship, preferring to pay those crews and those ships the maintenance costs, just keep them offshore, ready to come in should, trade deals come into place very quickly.
All right. Well, thank you as always, Alex and Kevin. Great
Absolutely.
discussion.
Thank you, Jeff. Have a good one.
Thanks.
Yep. Thanks.
All right. Welcome back in, Vimi Vasudeva, Managing Director on our desk and our resident MSR expert. Vimi, thanks for coming back on.
Thanks for having me, Jeff.
Yeah. So you've been catching up. There was a big servicing conference last week, IMN servicing conference, kind of where all the big industry players come in and do kind of a state of the MSR market. You were catching up with some folks who were at that conference last week, right?
Yeah, I was. I typically attend that conference. The IMN puts on this specific residential mortgage servicing rights conference twice a year. I wasn't able to make it this year, so I did make sure that I got notes from the field. We did have Tony Pacente, who's a senior account manager on our MSR desk, attend. And so I got a chance to catch up with him this morning to hear some highlights from the conference.
Nice. So what were kind of the big talking points from last week?
Yeah, so of course, this is not a surprise because the biggest change from the last conference in November is the administration. And so there was a lot of focus on the changes from the administration and particularly with respect to the CFPB. As we all know, the CFPB has been reduced in size. And, while a lot of panelists and many people out there agree that the CFPB may have overstepped in the last administration and become a little too punitive, there's certainly a benefit to having just one entity to deal with, regardless of the punitive nature. So with less oversight at the federal level, states will be now picking up the slack with respect to regulatory compliance.
Yeah, that's interesting. And so that just kind of broadens the amount of regulatory oversight that you have, right? So now you've got 50 different states taking on more oversight instead of one centralized regulatory entity, right?
Yeah, it was interesting because some servicers apparently mentioned that they've already started to see an increase in inquiries from the states. And what I mean by that specifically is that previously, while a 5,000 loan sample size may have been sufficient for regulatory monitoring, servicers commented on having to increase the sample size. And so 5,000 is not enough. Or another example was that instead of providing this sample size to one federal agency, they now have to supply it to 3 states, for example, if they operate in 3 different states. So that's a pretty big burden on personnel and many other things.
Yeah, we've heard that across the board, again, all the way from origination through servicing. And that ultimately just drives up costs, right?
For sure it does, because these servicers now have to add personnel to accommodate all the increase in the inquiries. So adding personnel adds to the cost, which decreases the value of the mortgage servicing right, which we know ultimately down the line impacts the borrower as well.
Yeah, it goes without saying. I mean, certainly, say like California is probably going to look at things a lot differently than states like Texas or Florida.
Yeah, good point. I guess on the other hand, the potential of this added personnel might mean that this is me trying to look at the bright side, but it might mean that those who have lost their jobs at the CFPB now might have opportunities at these state level agencies. So
yeah, I don't really look at the glass half full. That's good.
Yeah, trying to. You've got to in these uncertain times, right?
Yep. All right. Well, always the big topic is what is the state of delinquencies in the servicing market? So what are you hearing there?
Yeah, so a lot of discussion around Ginnie Mae delinquencies, which is not that surprising. I think a lot of people are viewing Ginnie Mae delinquencies as a canary in the coal mine, especially in the FHA side. So the last time I was on the podcast, I actually focused on the increase in VA delinquencies, and that was due to the timing of that podcast was around the termination of the VASP program that the current administration was terminating. And just as a quick reminder, the VASP program is the Veterans Affairs Servicing Purchase Program. And this was a tool launched by the VA last year, which was designed to help eligible veterans experiencing financial hardships avoid foreclosure and stay in their homes as another post-pandemic era relief program was dismantled. A lot of dismantling going on. And so then there's a lot of scrambling to try to figure out how not to have these be catastrophic events. So the last time we talked about VA delinquencies, and then at this conference, there was a lot of talk about FHA delinquencies, particularly with the 2022 and later vintages, they're starting to show cracks. I suspect this is due to the higher DTI and the higher LTV loans. And then, of course, just like I mentioned with the programs being dismantled, who knows how many more there are out there, which is certainly going to make it more difficult for FHA borrowers. And I think that modelers are already starting to model out an increase in FHA delinquencies because of this.
Yeah, we talked about that a little bit when we were talking about proposed budget cuts for 2026. So this could be definitely an ongoing thing to keep an eye on, right?
Mm-hmm. Absolutely. One interesting anecdote that Tony had mentioned was that back in 2008, there were a lot of people, as we painfully are aware, there were a lot of people that were okay letting go of their mortgage debt. They let it fail. But we didn't see that same trajectory necessarily in the auto debt space, because the mentality was, I have to get to work, so I need a car. I don't necessarily need my home. Like, I can figure that out. And then now, almost 2 decades later, which that's crazy to think of. It's been almost 2 decades, but almost 2 decades later, the mentality has completely shifted as many people have started to work from home or on a hybrid basis. The need for the car is just not there. And so, as we've talked about on the podcast previously, we have seen an increase in auto debt. So it's just interesting to see that mentality shift, whereas now it's like, I can't let my home go, but I'm okay with the auto.
That's fascinating. Yeah, it really just reiterates the point that all of this is about trying to model borrower behavior, right? What are actual borrowers facing as they're trying to make their mortgage payments? It's fascinating. It's a completely different dynamic now.
Yeah. So it'll be interesting to see if what else might shift because of that. So
yeah. Well, one thing that hasn't changed is I mean, you mentioned the FHA space. You mentioned Ginnie loans always kind of being the canary in the coal mine. So it's another one of those early indicators that we've been talking about throughout the economy of, are we at the precipice of a recession? And there's some warning signs, I guess, as you mentioned, that we might be, but we're not, it's not fully obvious yet, right? So we're just going to keep watching this closely over the next several months.
Yep. And listeners should tune into Optimal Insights to keep up to date on that.
Absolutely. Good. Maybe we can talk about a couple things about how people with existing portfolios, how can they make the most out of their existing portfolio, or how are people in the industry trying to make the most out of their portfolios right now?
Yeah. And so that actually brings me to the final point I wanted to talk about, was with respect to MSR values. So particularly at this conference, there is a lot of content around the valuation side of things, as opposed to the MBA servicing conference, which can be a little bit more operational. And so there was certainly a lot of panels around MSR values. And this has been a consistent theme in all the conferences I've attended over the last year, and that we've talked about on the podcast many times, but it's a whole concept of recapture and how that is impacting the MSR value. So MSR values are still quite high, and it is because of this recapture potential.
So reiterate that recapture concept one more time, just kind of breaking it down.
Yeah. And so the idea here is that if you are an originator and you sell your servicing to an aggregator, and you're basically getting rid of that borrower relationship. I mean, to put it very bluntly, right? You're selling it to someone else who now has more of an opportunity to recapture that borrower when the borrower decides to refinance. And so there's a lot of focus on those who can retain, should retain, particularly in this environment, so that they can keep the borrower close and they have more of an opportunity to hold on to that borrower for hopefully many refi cycles down the road.
Yeah, interesting. And obviously, again, that all leads to how mortgage company values that servicing, if they can value that recapture or not, drives the price that ultimately leads to the borrower. So it's the relationship and the price, huge components of this recapture concept, right?
Definitely. And so with respect to the price component, that leads me to an interesting point where, of course, so servicers look at it a little differently. And so some play the more conservative approach, and they do not include the value of the recapture because it's not as black or white as modeling income on payment and principal and interest floats, for example. Like there's a lot more steady data there to really ascribe a value. Recapture is really, it's almost like a bet, right? And so for that reason, some entities decide not to include it. Others do because they want to be more aggressive all the way down to the rate sheet, right? They want to be able to give the most competitive price, and they justify it by a higher servicing cost coming from the opportunity to recapture. But finally, regardless of what an entity might want to do, auditors also view this differently. So some auditors are okay with including recapture, and some absolutely are not. And it goes back to that same concept I just mentioned with respect to the predictability and being conservative with that or not. So lots of different considerations with how and when to include the value of the recapture.
And we see some wild discrepancies on what people estimate for recapture. It can be, anywhere as low as 5 to 10% to some crazy numbers out there of over 50%. They think their ability to recapture is over 50%, which has led to some very high valuations.
Yeah. And like that's what you're bringing up is probably what happened last year with certain aggregators that were really driving up the value and just being able to put really aggressive bids because of this belief. So
interesting. So last anecdote I think you had was kind of around some of the movement. We talked on this podcast a couple of weeks ago about the acquisition by Rocket of Mr. Cooper. And, one of the side effects of that, I think you got an anecdote from that as well, right?
yeah, absolutely. In fact, this just happened last week around the time of the servicing conference. And so when I caught up with Tony today, I asked, did this topic come up? Because it was very timely, but it didn't, probably because I think the news was released the day before the start of the conference. And so people were probably trying to wrap their heads around it. But essentially, last week, United Wholesale Mortgage announced that they were bringing servicing in-house. And they traditionally haven't held as much servicing as other lenders of their size. So it really does make sense now for them to do this, given that Mr. Cooper was one of their primary subservicers. And of course, with Rocket being one of UWM's largest competitors, and now with their acquisition of Mr. Cooper, it certainly makes sense for UWM to switch their strategy and bring servicing in-house.
Interesting. So, some of this stuff, somewhat subtle movements on the back end, but end up very much driving what pricing looks like to borrowers and what borrowers are seeing across the market that then, filters down to, even our smaller originators is something they have to keep an eye on because, a lot of those borrowers are using those, Rocket and UWM as kind of their bogey for what type of pricing they need to at least get close to, right?
Yeah, exactly. It's a good point.
Yeah. Interesting. Anything else?
No, I think those were the highlights, but I look forward to sharing what might be different 6 months from now at the next IMN conference.
Yeah, absolutely. No, always great getting your insights. I think thinking about how the state of the servicing market, because that does drive so much of the pricing that borrowers see, and we think about borrower behavior. It's fundamental to what we do in this industry. So it's always great getting your takes.
Yeah, thanks, Jeff. I'm always happy to participate on the podcast.
Cool. Thanks, Vimi.
Thank you.
Let's wrap this thing up. Another great episode. Thank you, Kevin, Alex, and Vimi, for some really great insights today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analyses and insights to help you stay ahead. Don't forget to follow us on LinkedIn and subscribe to our YouTube channel to access our latest video episodes. You can also find each episode on all major podcast platforms. Thank you for tuning in to Optimal Insights.